Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, what are ways you could measure this? Well, there's a couple of things. One, you could look at the chart itself. Two, over to the ISE website and take a look at the volatility for the pair, see where it's been. Now, you take a look at the YUK volatility, it's not really that bad, okay, when you consider what's happening right now, okay? Another chart that I was looking to take advantage of, a very similar situation, it's already happened, is the Aussie dollar. I don't know how many of you have been watching the Aussie, with these moving the way they've been moving, and the Aussie struggling on this. Here was the situation. Let me paint another picture here. Okay, and again, what I'm hoping is you'll learn to identify these opportunities, and you'll say to yourself, well, sure, I could look for opportunities to short into rallies up near 180-200, but maybe I'm better off, instead of getting short at that area in spot, maybe I'm better off just when we get up to that area looking for a put option. And that's exactly what I did in this situation as well. Okay, so again, and here's another scenario, but not that dissimilar to what was happening in the dollar-yen. I had a number of reasons here on the Aussie that I was thinking that perhaps the Aussie would start to lose ground against the dollar, even with the dollar in its weakened state. So let's discuss what's been happening in Australia. I have a friend who works for Interbank Australia, and I was telling him, I said, what's going on with the Aussie? We had this tremendous rally. We're kind of levitating up here, just below 200 parity. We hadn't been getting too far from parity, and the trading range was getting more narrow, and as long as the selling pressure kept coming in at 200, I was fine with shorting that, because a lot of times I could pull up, say, for example, a stochastic indicator, okay, and I could look for those over barrios, and as we were reaching the ceiling, I could short into that, sure, do a fade in this sideways market. But what was more appealing, interesting, what was more concerning even to me was, here's another country dealing with a significant event, weather-driven event. For those of you that remember, there was a significant amount of flooding up in the Queensland area. And by the way, I don't want you all thinking that I'm a fundamental trader, but when there are certain events that happen, you have to respect the fundamentals that are surrounding price action. I'm a chartologist. To me, everything is about price. Fundamentals are considered by the world, considered by traders and investors, and then they cast their vote according to their interpretation. Well, the only way I can measure the interpretation of what's being discounted and how it's being discounted, okay, is by looking at price, okay? So a couple of things were happening. One, the market really had not sold off when those floods came. In fact, if anything, it just leveled out. So here we have an area in Australia, and for those of you that are unfamiliar with Australia or never been, a large amount of the population is in that area. Australia has been having a tremendous housing boom. Sound familiar? And they've been building like crazy. Well, a couple things happened when the flooding occurred. The building just came to a screeching halt. Okay, and if I know one of the things that's supporting the currency, not only are strong commodities prices, because this is, after all, a COMDOL, but also the fact that the housing market's been booming and home loans have been moving up steadily and so forth, I knew that there could be a situation with this flooding, and then I started to hear confirmation of that from friends in the area, And also then I started to hear more and more commentary about it on the sites that I read, that the building basically was, like I said, screeching to a halt. Well, when there's no building, there's no loans. And I think it was about 2 weeks ago, the home loans in Australia during one of the economic releases, it was the first drop in home loans in 6 or 7 months. So now I'm saying to myself, well, when the flooding happened, the Aussie dollar did not sell off. It just kept exhausting at 200, and the range continued to narrow. Well, I mentioned when the range gets narrow and I see more of these blue candles for my grab, I get very excited. I start thinking about which way I think the market's going to move, and I try to take advantage of that quiet time, that neutral time, where I feel volatility might be less, and I can position myself within the trade that I'm waiting to happen. It might take some time, right? Position myself in a trade without tying up my valuable margin in terms of, again, my limitations from 100 to 1 to 50 to 1 in spot. So home loans started to drop. Buildings, the rampant building that was going on started to be affected by the weather. And because things were economically looking very shaky, one of the things that traders of the Aussie dollar were counting on, were expecting, was another rate hike. A rate hike from the Reserve Bank of Australia. And I kept thinking to myself, well, this might be one of the reasons it's able to hang on, because people are saying regardless of what's happening weather-wise and even with some of the recent fundamental data, we'll still surely have that rate hike, right? Well, the worse things got, the less the Reserve Bank of Australia could justify hiking rates, okay? Kind of like the unwinding and then of the euro-US dollar rate hike. We'll talk about that in a moment as well. So in terms of this sideways movement, sure, I could continue to use my stochastic and fade, but I really felt that there was a pretty good chance that we could move down lower. So the blue candles, I started doing what? I started shopping put options. My expectation was that at some point they were going to unwind that rate hike out of the expectation, out of the discounting of this pair. The fact that the flooding is affecting home loans in probably the most populated part of the country, and building was really being affected, at some point was really going to start to chip away at this Aussie against the dollar, despite the dollar's weakness. Well, here we're starting to really see that come to a head. Here we're starting to see that the Aussie is starting to break down. Now, this is just but one candle that's taking us out of the range. I don't know that that move is done. I'd like to think that it's not done. I'd like to think that perhaps we could even go down and test the 200-period simple. That'd be great. Okay, but my option, it was designed to take advantage of the fact that the market was consolidating, and that I felt as long as 200 really was a ceiling, at some point we were going to exhaust. At some point, the bulls were simply not going to be able to keep supporting this market with the fundamentals that were increasingly getting bearish, that were increasingly coming across as negative. At some point, the bulls were going to lose heart and quit supporting the Aussie up in this level, up above parity. And we've actually broken parity. And for those of you that understand the value of psychological whole round numbers, in the Forex market, there's nothing more significant than parity, than that one-to-one relationship. So that was a significant breakdown as far as that major whole round number move. Okay. So again, here there was another scenario. There's a lot of reasons for me to think there was a ceiling in place. I didn't really know how long or when the breakdown would occur, because I've been fading this for about 2 months. I don't want to sit in a spot for 2 months and hold all that buying power in a single trade. The option made sense. But if you remember, I alluded to before, time is a big part of what I don't mind paying for. Okay, I like to have time on my side. Okay, so I'd rather not. A lot of people will, instead of buying time, they'll look for in-the-money options. And if that's their strategy, that's fine. But for me, I'd rather have the time and not worry about time decay, be a little further out of the money, okay, and let my strategy kind of allow itself to play out. That's always my approach. I don't mind being out of the money, okay? I don't want to pay for increased volatility, so I look for those neutral candles. I'll look at the ISE website and understand what the historic volatility is doing. And then I will look to even buy my puts on days that are up, okay? Look for days that are a little stronger to buy my puts. And again, the whole logic behind that was this 200 ceiling, okay, as well as my feeling that something was going on with the Aussie dollar that had not yet really fully been realized and discounted, which was, again, the floods and the fact that in this environment it was less likely that the RBA was going to hike rates. So as we talk about rates, let's head on over to the EUR. So for those of you that trade the euro-US dollar, you know there are two ways to look at the euro-US dollar with FX options. You look at, obviously the EUI, okay, where it's the dollar-euro, or you can look at what I like to look at, which is the EUU. It looks more like the chart that you're used to seeing in the Forex world, which is the euro-US dollar, the euro, okay? So, spot, here's the euro-US dollar, which would then we'll transition over to the EUU. So this is a market that I've been swing trading. Now, both the examples we've looked at before were sideways markets, okay? And I know the topic of our discussion was trending markets, so I'm going to talk about a trending market approach right now. So how do I know, first of all, when a market is trending? Because part of my discussion always, as far as our trading of anything, whether it be options, futures, Forex, my first and foremost as a trader is to understand what it is that the dominant psychology is telling me about the market. Okay, so understanding that the dominant market psychology is incredibly important, okay? So just bear with me one moment here. So any strategy that I'm going to trade has to be based upon what the market trend is. What is the psychology of the market? Is it markup, markdown, distribution, accumulation? If I were to boil that down to even more simple terms, fear, greed, boredom, confusion. The market pretty much experiences one of those four, on a regular basis. Fear, downtrend; greed, uptrend; boredom, sideways, narrow range; confusion, distribution. All right? So when I want to look at a trending market, and here you can see a dominance of green grab candles, a little bit of blue, but for the most part it's all green, and the angle of my wave, the three moving averages, the green, the blue, the red, are heading up. And they seem to be supporting prices on pullbacks. When I have an environment like that, what I want to do is then consider, well, I sure would like to take advantage of the move higher. If I want to do so using spot, that's great. Now, how do I do it with an option? And how do you take advantage of an option in a trending market? When I may not have that many moments of a kind of a neutral market movement like I would see in a sideways congestion or consolidation. So what I like to do is, first of all, in a trend, a healthy trend corrects. So in this case, the euro-US dollar, one of my main philosophies, something I trust to happen regularly is the trend truly is healthy and to make corrections lower. Now those corrections could be corrections to the wave. Those corrections could be, for those of you that are Fibonacci fans, say a 38.2 or a 50% correction of the last major move, whatever it may be. A healthy trend at some point has to allow for some profit taking, and also encourage other traders to want to engage the market and then drive it up again. It's like the different legs or waves of a trend higher or lower. So looking at this, I know I want to get long. I don't want to fight the dominant psychology. Okay, although, by the way, if I did, here's two things when it comes to a trend. A lot of traders, at some point, if you're not in a trend, oftentimes it's very tempting to start picking tops. The only people who are looking for tops in an uptrend or bottoms in a downtrend are the people who are not already long the uptrend or short the downtrend. It's a psychological trap. I don't think it's contrarian, okay? I think to step in front of a freight train that's coming at you, in other words, a trend, it's a contrarian thing. I'm not on the train, so I'm going to step in front of it. And a lot of times, people who tried that, they get run over by the train. I don't want to step out in front of it. However, if I ever have the urge, we all know there's certain things that we just want to do as traders that aren't necessarily the smartest things to do. The option at least will give me a more manageable way of doing it. Okay? It'll at least give me an environment in which I can control the risk while I'm trying to execute a strategy which may not necessarily be the best thing to do. So with that in mind, I don't like to do that very often, but if I feel the market's getting toppy and I have, for example, past resistance, say 4,300. If I wanted to step out in front of 4,300 and look for a shorting opportunity, I'm not going to do so with futures. I'm not going to do it with spot. I'm going to do it with an option. As we approach that area, I'll look for a put. I won't just short into momentum. What I do want to do, if I'm trying to get long, however, which I think is the more prudent side of the trade, is understand where the corrections could occur, where the support is in the market, and on pullbacks to those support levels, like the recent visit to the 38.2 and the wave area, which was not only a swing trade on my, but also a opportunity to get long spot, but also purchase a call option. Okay, so I didn't want to buy the call up here. I wanted to buy the call on a pullback. Okay, that's the way I like to do it. So the market's moving lower. Remember, this is not a contrarian trade. I'm not looking to get long because the market's moving down. I'm not trying to step out in front of anything. What I'm realizing is that the dominant trend of the market is up. Okay, the sentiment, the momentum, the trend is bullish. So on a correction, simply to take advantage of support, and not only could, again, I get long in the spot or futures, whatever it is you trade, but I could also get into a call option. Okay? So that's another way you can do it. But the whole base of the strategy is that, one, you recognize what a trend is. Okay? And two, you recognize where the support in an uptrend is and where the resistance in a downtrend is. And when we reach those levels, you can then go about purchasing that call on the pullback to support or purchasing that put on the rally to resistance. But again, it's within the overall context of this is a correction of the uptrend. Okay, so whether it be Fibonacci, whether you use the wave, notice how well the wave acted as support. You can go ahead and position yourself in that way. Okay, and again, the driving force behind it is essentially the fact that, again, I feel that there is a dominant psychology, which is this uptrend, and I'd rather position myself with that long strategy on a pullback, not at a new high, not at a test of resistance, but rather a test of support. Does anyone have any questions about that? So the first thing, again, is the green grab, the upward, what I call 12 to 2 o'clock angle of the 34 EMA wave, kind of pointing up. But again, these green candles, most of them are up, some of them are down, but they're all green because they're closing above the 34 EMA high. That, for me, is a way to recognize that I'm looking at an uptrend, and because of that, I can also look to benefit from the pullbacks and feel comfortable in getting long. And if you do have an inclination that, for example, you feel 4,000 is a near-term ceiling, I would not recommend shorting an uptrend. You can short a sideways market like the Aussie at that 1.0200 level because there was not a trend that was in that on that daily chart or on that chart period. It was more of a sideways consolidation and a resistance level. Well, here there's arguably, resistance at 4,000, the major psychological level, but I would never, based upon this chart, look for a shorting opportunity with futures or Forex. If I wanted to step in front of that, I do so with a put option. And that's something my husband does very frequently. He likes to step in front of tops and bottoms like this when he feels there's going to be exhaustion, and he does it exclusively with options. That's something he's always done. If I see some sort of reversal or a doji or some sort of candle at a key level, and again, I may not want to get short an uptrend, but if I think there could be a pullback, okay, I don't want to short based upon that price movement on the daily. Maybe, by the way, there might be a different opportunity intraday, but based upon this chart, if I wanted to get short, position myself to take advantage of exhaustion at 4,000, an option is an excellent way to do so and still manage your risk. Does anyone have any questions? So not only taking advantage of trend following option buying, but also exhaustion and in the option buying process. So again, on the pullback for those calls, okay, so on those down days, I'm paying a little bit less. And on the moves higher, and again, this is within the context of a trend, this is when I'm looking for those puts, okay?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.